Did you know companies can literally buy and sell the right to pollute? Sounds strange, right? Welcome to the fascinating world of carbon markets, where carbon becomes currency. Welcome back to BizCase Studio, where we simplify MBA concepts through real case studies and practical examples. In this video, we will decode one of the most powerful tools in sustainable finance: carbon markets and carbon credits, driving the green economy. Before we begin, a quick note. If you would like detailed student friendly notes for this video or for any of our past videos in this particular playlist, you can grab them for just $1. The link is in the description. So don't forget to visit the store, and whichever notes you like, you can purchase from there just for $1. Let's start with the basics. What are carbon credits? A carbon credit is essentially a certificate that represents the right to emit 1 ton of carbon dioxide or its equivalent in other greenhouse gases. If a company invests in renewable energy, forest protection, or energy efficiency, it earns credits for the emissions it prevents. These credits can then be sold or traded in the market to companies that are struggling to meet their emissions limits. In simple words, carbon credits turn environmental responsibility into a financial asset. Now let's understand the concept of a carbon market. A carbon market is like a global trading platform, but instead of buying and selling stocks or commodities, participants trade emission allowances or carbon credits. Every company or country is given a specific carbon limit, a cap on how much they can emit. If they emit less, they can sell their extra capacity as carbon credits. If they emit more, they must buy the credits from others. This creates a financial motivation to go green because polluting more becomes expensive while reducing emissions becomes profitable. Broadly, there are two types of carbon markets. First is the compliance carbon market, regulated by governments, where participation is mandatory under law. Second is the voluntary carbon markets, where companies of individuals choose to offset their carbon footprints without legal obligation. Both systems share a common purpose: to make the environment part of economic decision making through market forces. Compliance carbon markets are mandatory systems created by governments to meet emission reduction targets. For example, the European Union Emission Trading System EU ETS, one of the world's largest, covers power plants, industries, and aviation. Similarly, China operates its national carbon markets focused on the power sector. In these markets, companies must hold enough carbon allowances to cover their emissions or face heavy penalties. So, compliance markets are policy driven and legally enforced. In contrast, voluntary carbon markets are not run by government but by private organizations and standard setters. Here, companies or even individuals choose to offset their carbon footprints voluntarily. For instance, a company might fund a solar farm in Africa or a reforestation project in South America and receive verified carbon credits. Platforms like Vera and Gold Standard certify these projects to ensure transparency. Voluntary markets are driven by corporate responsibility and branding, not legal obligation. Let's understand this with a simple example. Company A and Company B each have a limit of 100 tons of carbon emissions. Company A invests in energy efficient technologies and emits only 80 tons, saving 20 tons of carbon credits. Company B emits 120 tons, going 20 tons over its limit. So, Company B buys credits from Company A. This transaction rewards the cleaner company while penalizing the higher emitter. That's how carbon trading links profitability with sustainability. So there are four main steps of carbon credit trading. First is the measurement. That is where the carbon emissions are calculated. Second is the verification. Independent audit bodies ensures accuracy. Third is the certification. That is credits are issued to the verified projects. And fourth, the trading. Companies buy or sell credits on exchanges as per their emissions. Well managed carbon markets can create multiple positive impacts. They encourage companies to innovate and adapt green technology. They help countries reach net zero targets in a cost effective way. They channel private capital into renewable energy and conservation projects. And they make pollution a financial liability rather than a free externality. So, in short, carbon markets convert environmental goals into economic motivation. But carbon markets also face several criticisms. Some argue that companies use them to buy their way out instead of actually reducing emissions, leading to greenwashing. Others point to a lack of transparency and poor verification in certain offset projects. Prices of carbon credits often fluctuate wildly, making planning difficult. And developing countries sometimes struggle to access fair pricing or funding. So, the success of carbon markets depends heavily on regulations, credibility, and global cooperation. Here are a few key examples from around the world. European Union ETS, the largest and most established carbon trading systems globally. China National Carbon Market, focusing on the power sector, already the biggest by emissions covered. California Cap and Trade Program, a strong regional model that links with Quebec. India's carbon credit trading scheme CCTS launched recently to accelerate low carbon development. These examples show how countries are using market tools to meet climate goals. So, as MBA students or business leaders, here's what you can learn. Carbon pricing internalizes environmental costs into business decisions. Cap and trade systems show how policy and markets can work together. Innovation opportunities arise for companies that go beyond compliance. Understanding carbon markets give you an edge in finance, strategy, and sustainability roles, where green capital is becoming the future of business. Before we close this, here is something you can think on. And I really want you to think on all of these questions, and please provide your answers in the comment box so that we all can discuss, learn, and brainstorm it. Do carbon markets genuinely reduce global emissions, or do they just let companies pay to pollute? What do you think? Should carbon credits become a universal global currency for sustainability? Can developing nations truly benefit from carbon credit trading? What role should you, as a future manager, play or a policy maker in this system? Think on this and let's all brainstorm. Put your comments on the comment box. Start commenting and let's, all of us share our ideas on this. Thank you so much for watching this video. I hope this was a very informative one for all of you. So please don't forget to subscribe, to follow, to like, and to share BizCase Studio. There are more and more information videos regarding MBA topics coming. More and more playlists are coming. You can go and check our channel. We have some more videos and other playlists also. So please don't forget to subscribe and don't forget to like, and please share this to as many as possible in your network. Thank you and have a safe day.